Secretary WIRC. It's really an absolute pleasure for me to welcome you all on this evening for the lecture meeting on Finance Bill 2023. So before we start, I request everyone to please rise for the ICI motto.
सुप्तेषु जागृति य एष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता
Thank you. Finance Minister Nirmala Sitharaman Madam has brought a budget finally focus on the middle class, salary class and small business category taxpayers of India. The introduction of new slab under the new tax regime as well as the announcement of introducing a single simplified common ITR form in the future clearly shows that government's objective to simplify the income tax for the common people. But I think this is a big picture budget which is indicative of the government's transformation agenda. And to discuss more and in detail about the budget, today this meeting has organized and to discuss on the subject we have with us CA Gautam Doshi sir with us, a very eminent personality, past chairman WIRC, and I'm sure that the budgetary analysis presented here will create a great foundational knowledge base for our members. So I welcome you, sir, at the platform of WIRC, and thank you so much for the accepting our invitation. I recognize the presence of our Central Council member Durgesh Kabra sir also here. So I request our chairman WIRC, sir, please present a bouquet as a welcome gesture to our speaker. Also, I recognize the presence of our past president, CA Praful Chhajed, sir. Now it's a request to our chairman, sir, please address to the gathering and welcome guests.
Thank you, Shweta. Good afternoon to all. Let me first thank today's speaker, CA Gautam Doshi sir. Sir, thank you very much for accepting our invitation and joining us today. Everyone looks forward to this budget analysis. And although we've been doing it for last 2 years, but this year again we are back to the CCI lawn. So sir, thank you. Thank you for your support, sir. I also recognize presence of past President CA Prafulla Chhajed ji, Central Council member Durgesh Kabra ji, past Chairman Sanjeev Lalan, if I'm not missing past council members as well, Vice Chairman Yashwant, Secretary Shweta, and my council colleague Sanjay. And I welcome all of you friends here on this budget session today. I also recognize presence of my regional council colleague Saurabh. I'm sure Gautam Bhai will cover the direct tax aspects of the finance bill in a lot of detail. I just wanted to touch upon a couple of things. And one important announcement while we were listening to the finance minister live, she talked about creating of ports, infrastructure, warehouses, and also going interior into the rural India. And I think a lot of discussion I have been hearing after the COVID on the supply chain resilience, and I think this is one step towards that, so as to ensure that if an event like that ever happens again, the industries do not get derailed. And which also means that as a chartered accountant, we also got a lot of opportunities, especially if we practice on the side of real estate, construction, infrastructure, and we can even be a consultant, we can keep a watch, we can do the audits, end-to-end process audits, and do a lot of work there. There was one other mention about the whole artificial intelligence, AI, the robotic process automation, and again creating some center of excellence and creating experts there. I am pleased to also say that in ICI curriculum also we made a lot of changes. In the ITT, advanced ITT also now we teach Power Queries, but at WIRC we got some specialized courses also on Power BI, Power Query, Tableau, the presentation part of the data visualization part as I would call. And we are also doing some courses on coding, really doing programming using Python and SQL. So which is like doing data analytics ourselves in our offices. And we also tied up with a lot of software companies, and we are seeing young entrepreneurs, the chartered accountants being entrepreneur, a firm coming up with a third-party confirmation reconciliation software. So like it has moved from those letters going and getting posted to a software-based thing, confirmation. And similarly, a lot more on blockchain technology and other things. So I think we should all adopt technology, learn it, and use it in our daily life and also in our offices, and become a lot more efficient and effective. Before I end, let me take one more aspect from the budget and then I'll stop. So that is on the whole of ESG. I'm seeing that like it is talking about the green revenue or the green energy, or it is even talking about scrapping of old vehicles, and a lot of a step towards that. And as we all, I'm sure we would have all heard that ICI is the first institute in the world to come up with 16 sustainability standards. In India, the top 1,000 listed companies will have to do the BRSR audit this year, and we'll have to do the audit if we are statutory auditors of those companies. And in fact, India is also coming up with the first sustainability stock exchange. And NGOs and NPOs, if they have to list there, they will have to get a social audit done, which means again we'll have to do it. So I think whatever the government or the finance ministry is thinking of, we already taken a step, and it is on us that we take it ahead, learn the newer things, implement, and ensure that we all grow together and the nation also grows with us. With that, I welcome each and everyone again. Thank you very much for being here today, and hope you all enjoy and you have a happy learning. Thank you.
Completely echo with the chairman sir's thought. Sooner or later, we have to be updated and we need to adopt the technology. Thank you, Chairman sir, for letting us know about the activities of WIRC. So friends, we are very happy to announce that today two publications are going to release by the gracious hands of the Gautam Doshi sir. One is our Union Budget booklet and another publication on valuation. I request first to all the contributor of budget booklet, please be on the dais. Praful sir, Durgesh sir, please join us. Sanjeev Lalan sir, please join us. Shardul bhai, Saurabh, all the council members, central council member, regional council member, please join us. And next, be ready for all the contributors of valuation publication.
दे 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 ना, हाँ दे दे, हाँ दे. दे.
Request everyone, all the contributor of valuation publication, please join us on the dais. Thanks to all the contributors who has put their time and efforts to release this publication. Without this, it could not have been possible. Thank you so much. All the sister institutes, GSTPM, BCA, Chamber of Tax Consultant would like to thank each one of you for joining us today. So now the time has come for which we all are here and we are waiting for. But before handing over charge to Gautam Doshi sir, I request our Vice Chairman Yashwant Kasar sir, please introduce him.
Good evening, all seniors and CA colleagues. Friends, although CA Gautam Doshi sir needs no introduction among tax professionals, still I will introduce him before you. CA Gautam Doshi sir, a chartered accountant and masters in commerce, has been in professional practice for over 45 years. He advises various industrial groups, families, and also serves as independent director on boards of leading public listed and unlisted companies, including Sun Pharma and Piramal Enterprises. He has experience in wide range of areas covering mergers and acquisitions, direct, indirect, and international taxation, transfer pricing, accounting, and corporate and commercial laws. He has been actively involved in conceptualizing and implementing a number of mergers and restructuring transactions, both domestic and cross-border, involving many of the top 20 listed companies on BSE and also those forming part of FTSE 100. A prolific speaker, CA Doshi sir has addressed several seminars and conferences within and outside India and courses organized by Institute of Chartered Accountants of India, International Fiscal Association and other professional bodies and Chamber of Commerce as well. He has served on Council of Western Region as also all India level of Institute of Chartered Accountants of India, which has task of development and regulation of profession of accountancy in India. During his tenure on the council, he served on several committees and contributed significantly to the work of Board of Studies, which is responsible for education system of training of students. He has also served as the chairman of committees on direct and indirect taxation. So friends, with this I introduce Gautam Doshi sir before you. I request our chairman Murtuza sir to please felicitate Gautam Doshi sir with a memento.
Chairman of the Council, Regional Council, Murtuza, Secretary, Vice Chairman, professional colleagues, ladies and gentlemen. It's really a pleasure to discuss the provisions of the finance bill from this, I would say, hallowed podium, the podium which was graced by none other than Mr. Palkhiwala, and then my senior, Mr. Bansi Mehta, and now that I have the opportunity to talk to you, it's really an occasion which one cherishes. Thank you. We are not really going to discuss the budget. I would therefore not be dealing with perhaps what is more important, the CAPEX program, the various other programs which Murtuza mentioned, the various steps which the government is taking to take India forward, and all the announcements which have been made, which we need to look at very carefully, study and apply. But then as chartered accountants, we are equally concerned with the provisions of the finance bill, which matters to us as much as the rest of the budget matters to the economy as a whole and to all of us. But we concentrate a little more on this aspect of the matter. And that is why I would turn to the finance bill, which is the subject matter of today. Basically, the issue is, even as far as the finance bill goes, as the budget goes, in terms of tax, is it a giveaway? Do we have significant concessions? Do we have significant new taxes? Are we really continuing the status quo? And if we are continuing the status quo, what are the major changes which we are seeking to introduce? And I would try and deal with some of them, highlight some of them. Given the number of changes which are proposed, it is not possible for one talk to deal with almost all of those subjects. But the important thing is, let's look at what are the key issues. And the key issues primarily, the most important aspect from the government's point of view is the new tax regime. The one thing which the government wants to push, the government would like us to absorb and accept, is that we shift from the old tax regime to the new tax regime. But they want it as a voluntary task, not as an forced task, not as an involuntary task. So it is up to us to absorb and apply the new tax regime or not to apply. With one major change, this time onwards, the new tax regime will be the default regime. The old tax regime is something which you have to opt to apply. So it's up to you which of the two you want, but you still have that choice. So it really doesn't make a difference. Why the two? Why two systems? Clearly, the whole concept of the new tax regime is reduce the rates of tax, make tax reasonable, and if tax is reasonable, then you don't need to give deductions, exemptions, allowances to the same extent as they were given earlier. And in that case, the net result is a simplified tax return, a simplified tax assessment, a simplified procedure. So it's that is one of the major positives of the new tax regime. The negatives, as I see it, and this is something which government has consciously thought through, is the fact that under the old tax regime, you push people to invest. You say that you must buy an LIC policy, you must put money in PF, you must put money in PPF if you want to get a deduction under ATC. If you want to buy a house and then pay interest on that, we will allow that as a deduction. If you need to stay in your own house, in a rented house, then we will give you HRA, and so on. So there are a variety of deductions targeted at desirable objectives. The desirable objective being increase housing, increase savings. Those two clearly are targeted. In the new tax regime, What government is saying is, we'll leave the money in your hands. You want to invest, you invest. You don't want to invest and you want to spend it, spend it. We have no issues. We are not trying to tell you what to do with your money. Now it's, as I said, a great thing and a good thing and a welcome thing, but something which we have to consider whether for the economy as a whole, this is the right direction, or trying to nudge people into doing a little more of saving and to a little more of housing is useful. Anyhow, the government in the process is saying that we will give up roughly 5% of the tax revenue. So there's virtually no change in the corporate taxes. The total budgeted tax collection is about 14 lakh crores, of which about 7 lakh crores, 7.4, 14.4 is the total number, is corporate tax. And about 7 lakh crores is the tax on others than the corporates. The new tax regime is primarily applicable to individuals, HUFs, firms other than corporates. Because it is applicable to the others, we are talking about them. And the government says this will cost about 35,000 crores. So then effectively, it's a deduction of 5%. So government is willing to give away 5% of tax revenue to make people shift. Are there classes which will definitely shift? And the answer is yes. Anybody drawing up to 7 lakhs, there is no question of thinking. Under the old tax regime, your tax starts at 5 lakhs. Under the new tax regime, your tax starts at 7 lakhs. So where is the question? If you are earning up to 7, between 5 and 7, you are bound to go for the new tax regime because you just don't want to pay tax unless you have to. And if you are a salaried person, it would start at virtually 7.5 because you would also get the standard deduction. So that is one. If you are at the absolute other end, if you are earning more than 5 crores, then again there is again no thinking. The effective surcharge rate is reduced from 37 to 25, so that the marginal rate of tax comes down from 42.7 to 39, and a saving of 4% on 5 crores is 20 lakhs. The saving is so large that you would not even have to make any calculation, any thinking. You are bound to adopt the new tax regime. It's only for those in between that you would have to calculate. You would have to decide which of the two is more beneficial to you. Your deductions, if you are around 15 lakhs income, then a deduction of 3.5 lakhs will put you on par. It will be the break-even point. If your income is larger, say 2 crores, a deduction of 3 lakhs is enough to make it break-even. Because as your income goes up, your rate of tax goes up because of the surcharge, and therefore even the lower deduction gives you the same tax saving. So effectively you get your tax saving by deductions of between 3 lakhs to 3,75,000. And what could be those deductions? Say interest on housing could be 2 crores. 8IC deductions could be 1.5 lakhs. In the national pension scheme, for medical insurance, ATG, these are all standard deductions which would make up for that 3 lakhs to 3,75,000. And you should therefore be in a position to pay the same or lower tax even under the old tax regime. So it is left to each one. The other things in relation to rates of taxes which one may talk about are the changes in relation to cooperative societies. But the two major changes which are there are, one, again, for both are for, to an extent, salaried employees. Housing, new rules are going to come. The rules have not been notified. Only the fact that new rules will come for housing and concessional housing, rent-free accommodation and concession is indicated. So those new rules will decide what modality to adopt for the purpose of housing. And the other is leave travel concession. It's only for those who are retiring, those who are leaving employment. But at the stage when you are leaving employment, if you have 10 months of accumulated leave, you can get up to 25 lakhs of exempt income instead of 3 lakhs of exempt income. Government suddenly realized that we had promised that we would keep on reviewing this limit of 3 lakhs based on the maximum slab of salary for government employees. But for the last 20, 25 years, we haven't done that. We have not revised this. So while we had promised in the act that we would revise it, we forgot to revise it. Now at one stroke, we are revising it from 3 lakhs to 25 lakhs. Then coming to what are we trying to do for industry? Because that is, after all, the most important. What is the incentive we are giving for industry? And I would see only two major incentives. One is the relief for startups to some extent, and the other is the payments for MSMEs to try and make sure that they get their money in time. These are the two major things which one is looking at. So far as startups are concerned, and India is now one of the leading nations of the world in terms of the number of startups, in the terms of the number of innovations, in terms of where we are going with this particular area. So we are amongst the leaders, and we need to keep on encouraging that area. And so we are doing that. One is a very minor change, but a change that in order to get the benefit of Section 80 IAC, which gives startups a tax holiday for 3 years out of the first 10 years. They choose. So you choose the 3 years for which you want. If you are profitable also, you may wait till the 7th year. You may take 8th, 9th, and 10th year, because those are the years when you make the maximum profits. And if you are not profitable, naturally you will wait till you make profits. So startups choose the year in which they are going to claim this set-off. So that to claim this benefit, you should be incorporated before 23. Now it is before 24. So this has been extended by 1 year. It's a, as I said, minor change, but this has happened consistently for the last 3 years. Every year we have been told it is now being extended by 1 year. So hopefully we will see it next year also. Even if you start by 25, you should get it if the same trend continues. The whole idea is like a sale. It is stopping tomorrow, so please buy today, and then you extend the sale. You don't extend the sale till the last day. So it is a sale which is perhaps going to be extended. But on the other hand, we expected the same extension for corporates. If you set up a new company in manufacturing, then you would get a lifetime benefit of paying 15% tax instead of 22. That's a significant benefit, 7% lower. Now that benefit is available to a company which starts manufacture before 24. That has not been extended. Whether it will be extended next year, difficult to say. But this type of incentive requires extension in advance. A manufacturing unit is not set up within days or even months. It takes a year, 2 years, 3 years to set up a manufacturing unit, and therefore the extension should have come earlier. One would have been happy if one had seen it. It's not there. Perhaps it will not come, then you will shift to the 22% tax regime. Not as good as 15%, but not terrible. One can think of setting up a small company, small manufacturing operations, namesake if you like, before 24, so that you have put your foot in the door. That company can then expand. It can expand in 28, it can expand in 30, and the profits will still be chargeable at 15%. So you have your right to that 15% lifetime tax by setting up before March 24, and you still have 1 year. And if you are really thinking of just a small token manufacturing operation, 1 year is perhaps enough to be able to set it up. So you could avail of this advantage. The fact that it is not extended seems to suggest it may not get extended again. Cooperative societies also have been extended, but they have been brought in for this, but again only till March 24. The other benefit for startups is a very difficult one to accept, or whether it's a benefit or not, which one of the two is better, one cannot say, is how I would put it. What we are talking about is, if a startup is making losses, it can carry forward its losses like any other entity. It is entitled to carry it forward and absorb it within 8 years whenever it makes profit. So the loss of year 1 can at best be absorbed in year 9. If you can't absorb it in year 9, the loss of year 1 will lapse. Loss of year 2 will then be absorbed in year 10 and so on. You need to start making profits someday or the other. Losses can't continue forever. So you have 8 years to absorb. A condition is imposed to be able to carry forward losses. The condition is that in the year when you make profits, so year 9 in our example, assuming you have made loss in year 1 and you want to absorb it in year 9, the shareholders in year 9 who hold 51% of the company must be the same as those who held 51% of the company in year 1. That's a condition. So the idea is you don't trade in losses. You don't make losses and then sell your company to somebody saying, okay, pay me for the fact that now you are getting benefit of brought forward losses. You will be able to absorb your profits against it. In any case, I have nothing else, so at least I get paid for the losses I have suffered. That is not permitted. You are not allowed to trade in losses. So 51% continuity is a condition. For unlisted companies, it does not apply to listed companies, but we are talking about startups, we are talking about by and large unlisted companies. Now, startups have been given one concession, but the question, as I put it to you at the beginning, in my mind, I'm not sure it's a concession. I'm not sure it is desirable. The concession given to them is this 51% rule will not apply to you, provided all those who held shares on day 1, at the end of year 1, 100% of them continue to hold shares even in year 9 and again hold all the shares which they held in year 1. So in short, still no trading. If you held shares, you continue to hold shares and you continue to hold all the shares which you held in year 1. But because you needed more money, because you needed more investment, you can bring in an investor and the investor can take 40, 50, 60, 70%. So long as you continue to hold your shares, you will get your losses carry forward. That is the condition. That is why I'm saying it's not sure that it is a concession because 100% must continue. Now in a startup, by definition, very often even this does not happen. Startups are a combination of 2, 3, 4, 5 friends. They are not always one person. Very often that's the way it is set up. Then you have ESOPs, you have people getting some ESOP shares and so on and so forth. And you always have the possibility and the strong possibility when you have 5 friends that 2 of them want to exit down the road. Not everybody is willing to live with the vision, the mission, the concept of that startup and its future. Some people get tired early, some people have the strength to wait. But if 1 or 2 of them get tired, you lose your losses. Or you lose this concession of being able to carry forward by keeping 100% of the shareholders. Now this condition also has a time limit, 7 years, that if by year 7 you can't achieve, then you can't get the benefit of this condition. That 7 has now been made into 10. It's not a very significant change. That's a small benefit available. The next major benefit, if you like, is for MSMEs. MSMEs, the government has consistently been trying to frame a policy to make sure that large industries pay MSMEs on time. Because they must get their working capital. Without that, they are not going to be able to function. So now you have a whole MSME Act for that. And the Act has a variety of provisions, including provisions which say if you don't pay on time, you will have to pay interest, you will have to pay penal interest, you will be penalized for it, and that penal interest will not be allowed in tax and so on and so forth. Fact is, with all those provisions, industries who can afford to negotiate, industries who can afford to put their terms to the MSMEs still fail to pay on time. Because the large industries also want to retain their working capital. So this is the position of the MSME Act. This is the position of disclosure. You are required to make various disclosures under the Companies Act, under various other acts. So you have to give a list of those MSMEs, I mean, how many of them you have not paid, how much you have not paid, what is the interest due on that, and so on and so forth. One more condition has now been added. If you don't pay them on time, then that payment itself will be disallowed for tax. So if you are in the 30% tax bracket and your effective tax rate is 35%, if you don't pay the MSME on time, you will then pay 35% extra tax. For the 100 rupees which you want to claim as a deduction, you will not get, you will pay 35 rupees on that. That is what it is effectively saying. Of course, it is not MSME as a whole, it is only micro and small. It does not apply to the medium enterprises. This rule applies only to micro and small. Micro and small means between up to an investment of 5 crores and turnover of 50 crores. So we are really talking about small entities who are getting this benefit. It's a, perhaps there is a small drafting anomaly, which one may point out. What is disallowed is a payment which is due, which is overdue under Section 15, so to say, of the MSME Act. Section 15 of the MSME Act refers to a payment to be made within the period specified in your agreement, but the agreement can't provide for more than 45 days. So even if your agreement says you will pay at 90 days, the maximum time for the micro and small industry is 45 days. That is what the Act provides. So notwithstanding your contract, you have to pay on the 45th day. And if you don't have a contract, you have to pay on the 15th day. That is what the MSME Act says, Section 15, and this refers to that section. So a supplier under that section, if to the extent he is unpaid, you will face a disallowance. Now, if I have bought goods on 15th February, and my contract provides for 45 days, the money is not due on 31st March. So it's not overdue. It is not payable. It is not payable as per the MSME Act on 31st March. So it should then not be disallowed. Next year I may not pay on time. But that is next year's problem. It is not this year's problem. This year's assessment must go by, is it overdue in this year? And the answer is no. So perhaps one can get that small advantage. The second is, even if you pay late, amounts due in May, you pay as late as January, you will still get it. The fact that you pay is enough to get a deduction. And if you don't pay in this year and you pay in the next year, you will get a deduction in the next year. So it is so long as you pay, you will keep getting your deduction. Then turning to some amendments relating to, I would say, simplification, because I really don't find much which helps industry other than these two. The startup and the MSME, and as you can say, it's not really a very big boost or incentive, but it is there. The next, I would say, is ease of compliance. Where are we making it easier to comply with the tax law? One is the threshold limits for presumptive scheme. This, to some extent, is a real benefit, but again, it depends on how it is interpreted, how it is understood. What is the presumptive scheme? The presumptive scheme is for businesses and for professionals. For businesses, if they have a turnover of less than 2 crores, and for professionals, if they have a turnover of less than 50 lakhs. In that case, for businesses, you pay tax on a presumptive profit of 8%, and to the extent that your money is coming in through pays, account checks, and electronic means, 6%. So effectively, today, major part of the transaction is at electronics, so 6%. So that's a significant saving. That is your profit. And if you are a professional, your profit margin is 50%. So if your turnover is 50 lakhs, your profit is 25 lakhs. That is the deemed profit, that is the presumptive profit, that is the profit on which you will pay the tax. That is the provision. The uncertainty is, I am a professional, I have a turnover of 45 lakhs. By this rule, I should pay tax on 22.5. My bank account shows that out of 45 lakhs, I have spent only 5 lakhs on salaries and rent. I have still got 40 lakhs lying there. Do I pay tax on 22 and a half, or do I pay tax on 40? I don't really know the answer, but the better view seems to be, and some tribunal has accepted it, that the language of the section says or. So if you want to pay tax on 40, you are welcome, it says. But if you want to pay tax on 22.5, also that's permissible. Nobody is telling you to pay tax on 40, so choice is yours on what you want to pay, 22.5 or 40. So as I said, that is one which is uncertain. If, however, it is interpreted to mean that you must pay tax on 40, then this is not a very big advantage. Then what is the second advantage of this presumptive tax? You don't have to keep books of accounts. But in today's world, does that work? You have to file GST returns. You have to file other returns with so many other authorities. And how are you going to deal with all of those if you don't keep books of accounts? A business with 2 crores of turnover can't remain without books of account in that sense. So not maintaining books is an option given to you, but it's not a great option. Not having tax audit is a good option. You don't have tax audit as a result of this if you are under presumptive. That is the advantage. You will not have scrutiny. The officer will have to accept your return. The moment you file it, so to say, he cannot go behind it and find out what is your real profit. That is the real advantage. So it's a significant benefit, if you like to put it that way. The benefit is now being extended. The limit of 50 lakhs is now being made 75 lakhs, and the limit of 2 crores is being made 3 crores. That is the main advantage. So a slightly larger part of the population will be covered. The question does arise whether it is a benefit for businesses as opposed to professionals. Because this benefit of 2 to 3 has a condition attached. It's always there, you know, that small asterisk of any sale, terms and conditions apply. So the terms and conditions apply to this. There is a condition attached. And the condition attached is that your turnover should be 95% in payee account, check and electronic means. It cannot be in cash. So a retailer who does cash business cannot take advantage. For him, the 2 crore limit remains 2 crores. For a person who is otherwise doing business where people pay by check, yes, 2 crores becomes 3 crores. But if you get payment by check and electronic means, audit is exempted up to 10 crores. So then this 2 becoming 3 is of no use to you. You are in any case exempt up to 10 crores. So this is not really a big advantage for them. It may be a big advantage for professionals who go from 50 to 75. The next change, which is again meant according to them to simplify the tax law, but which I think is going to lead to a significant amount of litigation, but positive litigation, not negative litigation. Today, if you buy an asset, the normal rule of law is whatever interest you incur up to the day on which you put that asset to use, that you can add to the capital cost. Because till then the asset is not ready. That's part of your capital cost. If you are installing plant and machinery and it takes you 6 months, all your borrowings for the plant and machinery for that 6 months, the capital cost of the plant goes up by that much, and you will get depreciation on that. After 6 months, you can start claiming that interest as a deduction. That is the current rule. If it is a house and you are a salaried employee, all this makes no difference. For you, there is a special deduction of 2 lakhs. If you, as a salaried employee, have bought a house from borrowed funds, you also get a deduction of 2 lakhs. Now, according to them, some people attempted that they claim that 2 lakhs deduction because it was available under section 24, specifically written. But when they sold the house, they said the cost of my house includes this interest of 2 lakhs, which I have claimed as a deduction. And if it was held for 10 years, then we are saying 20 lakhs extra to the cost over that period. So they added that to the cost. What they are now clarifying is this interest which you have claimed under 24, you cannot claim again as a cost. I mean, a logical, correct amendment. You can't claim a double deduction just because some tribunal, some high court accepted it, saying that the two sections are different. One is section 24, one is 48. The two heads of income are different. One is house property, the other is capital gains. So I will give you the deduction. Doesn't mean you should get the deduction. So rightly so. But does this mean that interest on an asset which I'm already using is also cost? Because we are now talking about houses used by salaried employees where they are staying, and they are claiming that 2 lakhs. And you are saying that, but for this provision you were claiming that cost, we will now not allow you the cost. But this therefore effectively implies that interest is a cost which adds to the cost of the asset. And there are court decisions. If I have bought shares and the shares have not yielded dividends for the last 10 years, that company has paid nothing, and I have bought shares from borrowed money, can I add the interest on borrowed money to the cost of shares? So that in the 11th year when I sell it, I make a lower capital gain or make a capital loss. Do I get that over and above indexation? That is so that is the type of question which is coming up. As I said, this is an inference which one can draw from this amendment. Because the amendment in categorical terms, the explanatory memorandum seems to suggest that but for the amendment, this interest is a cost. And it is a cost which is allowable. And that all that we are doing. And the amendment only restricts itself to section 24. So if you claim interest under section 36, you claim interest under section 57, you claim interest under any other section, then effectively this is saying okay, that adds to the cost. I don't think this can be the intention. I'm sure they will clarify. I'm sure they will say okay, this was never intended by us. This seems to be an oversight in the way we drafted. It's not an oversight in the way they drafted the act. It is partly there. But it is even more of an oversight in the way they drafted the explanatory memorandum. Then coming to, and with this, in a sense, I come to the end of the few positives which I can find in the finance bill. The rest of them are restrictions and or negative conditions to plug loopholes. One does not really look upon them as positives. Amongst those, the first is those which are restrictions on HNIs. Our constitution still says we are a socialist country, and we continue to some extent to believe that, and therefore there is a time when we put a restriction on HNIs. Now on the one hand, the new regime has given a very big benefit to them. If you earn more than 5 crores, your effective surcharge comes down from 37 to 25, your rate of tax comes down from 42.7 to 39. On the other hand, we are now putting restrictions on them through these sections. The first restriction is on the reduction under section 54 and 54F. The two sections have been combined. I mean, the same amendment has been made in both of them. One would feel, with respect, that it is illogical. The purpose of both the sections is not the same. If you are giving a benefit for X reason, you withdraw it when X reason is being misused or is being used by somebody whom you don't intend it to give. But you don't withdraw it for somebody else. 54, to my mind, is a concession which really simply seems to suggest if you have one house, you sell it and buy another. So long as you keep on with that one house, which is your own, you should not pay tax. 90% of the people have one house in which they live. They have to use that house for themselves. And if they have that one house and they want to sell it and buy a bigger house, they should not be compelled to pay capital gains tax at that point of time. That is what 54 says. Yes, 54 also can be used for selling 4 houses and buying one, selling houses which are given on rent and buying another. You can remove those conditions. You can say that 54 will be available only to self-occupied houses, which was what it originally said at one time. And you can say okay, it will be available only to one house. That I would have thought is logical. But if my existing house is worth 50 crores and I sell it and buy a new house for 60 crores, then I should get a deduction, because my current house itself is that big. But the condition now being imposed is, as far as your new house is concerned, we will treat the cost of the new house as 10 crores. We will ignore the fact that you have paid 60 crores for the new house or you have paid anything else for the new house. We will look only at 10 crores payment. So if you have made a gain of more than 10 crores, let us say this 50 crore house you had bought 50 years back at 5 crores. So your gain is 45 crores. You have bought a new house for 60 crores. You will still pay tax on 35 out of 45. Your new house is worth 10 crores. Out of 45, 10 will be given as an exemption, 35 will be taxed. So you will, shifting from one house to another will become that much difficult. So that's as far as 54 is concerned. And to my mind, it should not have been applied to 54. It was uncalled for. The second section to which it applies is 54F. That provides for mobility. What is 54F? 54F is if you sell any asset other than a house. You sell land, you sell shares, you sell jewelry, you sell anything other than a house. You make capital gain on that and then use that to buy a house. Then again you are exempt. The condition under 54F is you must invest the entire sale proceeds. Under 54 it is enough to invest the gain. When 5 was sold for 50, it is enough to buy a new house of 45. You would still get deduction. If it was 54F, if 5 lakhs worth of shares are sold for 50 lakhs, you must invest 50 lakhs in the house, the sale consideration. Now again, the same rule is being applied. Whatever new house you buy will be deemed to be worth 10 lakhs or 10 crores in this example. So 10 by 50, you will only get 20% of the capital gains as exempt. Because you sold it for 50, you bought a new house for 50, but only 10 out of that is considered eligible. So 10 by 50, 1/5 of the gain is exempt. If your gain is 45, 9 crores is exempt, 36 crores is taxable. That is the amendment of 54F. The people who have drafted this have not understood this distinction between 54 and 54F. The explanatory memorandum says that in both cases your capital gains will be restricted to 10, exemption is restricted to 10 crores. That's not correct. In the second one it is restricted to less. As I said in the calculation, it's restricted to 9 crores. In the first it is to 10 crores. So it is not the same. That's a mistake in the explanatory memorandum, and that only shows it's a mistake of the people who have drafted this section. They can change that and they can provide now that instead of treating the cost as 10 crores, we will treat gain up to 10 crores as exempt. That would be more logical. Hopefully they will make this amendment. They have been reducing these limits in other sections also. Like for investments, you make into desirable sources certain types of bonds. Originally in 1978 it was introduced, you could put capital gains into any amount. And by 2007 you brought it down to 50 lakhs and so on. So this is one more reduction, 54 to 54F. There is another drafting anomaly which one must point out, which will hopefully get corrected. 54 and 54F both have a condition that the new house which you buy, you should not sell for 3 years. And if you sell it within 3 years, then the gain originally allowed to you as exempt will be taxed. So that is fine. In the context of 54, that is the language of the Act, 54F. So if you sell this new house in 3 years, the 10 crores exemption which you got, you will not get 10, as I said, you will get less. Maximum you can get is something like 90-95%, depending on your ratio of gain. That exemption will be withdrawn. 54 has a slightly different language when originally drafted. The language says the cost of the house will be taken to be nil. So I bought the house for 50. You are treating only 10 crores and giving me exemption of 10. That's okay. Now if I sell the house within 3 years, you are saying my cost is 0. Not even 10. And I will have to pay tax on the entire capital gains. That cannot be the intention. That clearly is an error in drafting. That is not the objective in this type of situation. Then the rate of TCS and the life insurance policies for HNIs, these are the two other conditions which perhaps will hurt HNIs. As far as TCS is concerned, tax collection at source, not tax deduction at source. Collection at source is if you carry out a transaction where you are buying, you are not earning an income. If you are not earning an income, there is no question of deducting tax. So there is no tax deduction at source. But instead of that, there is tax collection at source, namely the man from whom you are buying will still collect tax and pay it to the government. The whole idea being, if you can afford a transaction of this size, you should be in the books of the government. And if you are not in the books of the government, I will collect this tax and send it to them. So they will come back and ask you questions. And based on that, because you are somebody who can afford to do large transactions, you will effectively tell them the truth and pay your taxes. That is the idea. Till last year, therefore, the TCS was 5% on foreign remittances under the LRS scheme and on buying overseas tour packages. It was 5%. And the idea was right. That 5% will give government information about me. Once they have the information, I will get a notice. Once I get a notice, I will have to tell my true income, and if I have income in crores, I'll pay tax in crores. But apparently government finds that though they get the information and they send the notices, they don't get replies. They are not able to find out who is it that who actually remitted the money or who bought the package and whom to tax and how to catch him and what is his income. Their systems are not effective. So what they are now saying is, instead of 5%, we will collect 20%. Then tomorrow, even if we can't find you, at least we have got 20% tax. So we are not totally out of pocket. That is the idea. So that is the effective change which is being made. Increasing the rate, as I said, all that you are doing is remitting your money overseas to your own bank account outside India. You are not doing anything else, but you will in the process pay 20%. You are allowed to remit up to $250,000 as a resident. That's roughly about 2 crore rupees. So if you remit, say 2 crores, you will now first pay 40 lakhs to the bank. And the bank will take that 40 lakhs and give it to the government. You will still remit your 2 crores. Your 40 lakhs is not lost. You will get credit for it when you file your return. And you will get your refund of that 40 lakhs if you are not liable. If you are liable, it will be adjusted. It's not a loss, but it's a major cash flow hit. And for those who don't file returns, this 40 lakhs is a leakage. They have lost their money. They have remitted this, but they have lost that 40 lakhs. So that is the idea for LRS remittances. Is there a concession given? The concession is given. If this LRS remittance is for education or medical purposes, then we will charge only 5%. So one concession, then in that case you don't have to pay 20, you have to pay 5. How will the bank know that it is for education or it is for not for education? There is no clarification in the act. I think the answer will be, it will be deemed to be, if you say it is for education, bank will accept it is for education, they will deduct 5%. If you say it is not for education, then the bank will deduct 20%. So this is going to be one. There are a number of other issues there which one can talk about, repayment, etc. And one very esoteric thought on the overseas packages. the condition is that if you buy an overseas tour package, you have to pay 20% TCS. So if I buy a package for a trip from Mumbai to London to Spain to Portugal to back to Mumbai, and it pays for my air and hotel and everything, then on that package I have to pay 20% TCS. But if I buy it from an Indian party, if I buy it from a travel agent in London, he is not liable to pay TCS. He is not subject to the laws of India. So the travel agent in London will perhaps not charge this 20% TCS. So does it mean that Indian travel agents will set up subsidiaries in London and sell me this package from the London company? So at least I don't have TCS. Hopefully that's what will happen. You will have more and more companies outside India from which you will buy these packages. That's one. And the second thought which one has is, the language says, if you receive the money from the buyer, the man who's buying the package, if he pays you, then you have to deduct. So what if I pay through a credit card? I am paying the bank and the bank is paying him. I am not paying him. In that case, hopefully the TCS should not apply, because the bank is in between me and him. In the rare case where I don't pay the bank, he will still get his money from the bank. The bank may then file a suit against me, do what it likes to recover, but he'll get his money. So there is a difference. I am paying the bank is paying him. So in that sense, perhaps there would be no TCS if I use a credit card to pay that. The same may not be applicable if you use a debit card, I don't know, because a debit card will directly be debited to your bank account. So it may be held that you are paying it. But a credit card should work. The next is on life insurance premiums. You now have for HNIs a condition that if the life insurance premium is more than 5 lakhs, then you see, exemption at the time when you get the money back is lost. Basically, savings schemes have 3 possible routes: exempt, 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 namely exempt when you deposit, exempt when you get your interest, exempt when you get your money back. Or you have only the next 2 E's. So it is not exempt when you deposit, but exempt on the yield, exempt on the return. Or only last one, exempt on the return, any one of them. By and large life insurance policies, the first E is not there, because ATC is limited to 1,50,000. So the first E is not there. The second and the third E's are there: exempt on the yield, exempt on the return. Now what they are saying is, the yield is only added as a bonus and is given to you on return. That exemption on return is withdrawn if your total premium for life insurance policies bought after 23, from April 1, 23 onwards. So whatever you have bought till today is safe. You don't have to worry about the policies which you are already holding. But if you buy new policies and your total premium exceeds 5 lakhs, then when you get it back, whatever you get back will be taxable. So the yield will also be taxable and the return will also be taxable. It will be taxable subject to a deduction of the 5 lakhs which you paid, subject to a deduction of the premium which you paid, with a condition that if somehow you have managed to deduct that premium under any other section of the Income Tax Act, then naturally your deduction will be restricted. You can't get double deduction. So that's an attempt to control high value life insurance policies, perhaps justified because all that you are trying to say is people at this level don't need the exemption. Let them select where they want to invest, etc. But you don't have to incentivize them by an exemption to buy life insurance policies. So those who can afford to pay a premium of more than 5 lakhs, let them pay taxes. That's the effect of this provision. The negative is you are charging it as other sources income as full tax. The correct way to tax would be capital gains. This 5 lakhs which I paid is a cost. What I get back is the sale price. Sale price minus cost, you charge me capital gains. Rate is lower, 1. 2, if there is indexation, I may not really make a profit on life insurance. The indexation and the actual profit I make may be fairly equal. If I make a profit, good luck to me, I'll pay tax. If I don't make a profit, I don't pay tax. Subject to indexation, because indexation is only a return for inflation. When I get my money back more, I'm not really getting more. I'm getting the same real value. It's only that the rupee has depreciated in value. What I could buy for 5 lakhs, I can now buy for 10 lakhs. So I'm not really making a profit. So they should allow me capital gains and indexation rather than charging the whole amount to tax. So the concept is right. The concept that you withdraw exemption from the HNIs is right. The way in which it is being done is a question mark. Perhaps it could be done in a better way. And I'm sure the life insurance companies will go to government and hopefully they will be able to convince them that this amendment should be done in a different way. It should not be so harsh. Then come the provisions which are meant to plug existing loopholes or what they think are loopholes. And the first one which seems to be a misunderstanding to an extent, or again which should have had a different type of amendment, is that dealing to writs and InvITs. What is the amendment? Or what is the scheme? When you buy a unit of a writ, you get returns on that unit in the form of interest, dividends, and repayment of debt. Dividends and also sometimes rentals, but rentals are rare. So what it means is the writ takes your money, buys a property, lets it out on rent, earns income. Now it doesn't do it directly, it does it through an SPV, a company which is below the writ. That company buys the property, earns rent income, pays interest, pays rent to the writ, and the writ in turn distributes that interest and rent to you. If that company pays a dividend, they also distribute the dividend to you. Dividend, interest, and rent are passed through. The writ does not pay tax. The SPV pays its own taxes before declaring dividends, interest, rent. Interest is deductible, dividend is not, but whatever the law be, the SPV complies with that. The writ in between does not pay a tax, you pay tax. It's like you having bought a property and given it on rent. What you would pay otherwise, you are paying. Now, the writ may have given a loan instead of investing in the equity of the SPV. So you can buy the shares of the SPV in the writ, that you must buy. The writ must hold 51% of the shares. But in addition to that, it can give a loan. Now, if it has given a loan, as and when the SPV earns money, it repays the loan. That's a normal repayment of loan. Naturally, the writ does not pay tax on that because you have given a loan, you are getting your money back, there is no income. That money the writ gives back to the unit holders. The unit holders also therefore don't pay tax on that because this is really a repayment of debt. This, they are saying, is a loophole. They are now saying if the writ gives the money back to you, even if it's repayment of debt, you must pay tax. Now, logically correct. Why? Because really this repayment of debt is a repayment of my investment in the unit. Then it should not be taxed. But I'm not reducing the cost of my unit. My cost, if it was originally 100, I'm not reducing it. If I'm not reducing it, then this repayment of debt should be charged to tax. And that is what they really want to do, that this repayment of debt will be charged to tax because you are not, in that sense, earning it as income or you are not reducing your cost. But I think the correct amendment would have been to say, you will reduce your cost so that as and when you get capital gains, you will pay more. That's all that was required. Because if you get your money back, if I've invested 100 and you give me 20 back, my investment is 80. My investment is no longer 100. I can't claim 100 as a cost. And if I'm claiming 100 as a cost, yes, you make a law to say that my cost will be 80. But you can't therefore make a law to say that 20 is income. But we have now made a law to say that 20 is income. Effectively, one has gone the other way around. That is the problem. So one hopes that this will again be amended to provide for this reduction from cost, you can do it either way. You can say it will be taxed year to year. 20 has come back, 1/5 of the cost will be deemed to be the cost of that year, 20 will be the sale price. If there is, you have got 22 for it, you pay tax on 2 rupees. That's all. But that's the way it should be, or just reduce your cost, one of the two. Let's hope that there will be a logical amendment. The current amendment is harsh, and the second harshness is the same like life insurance policies. When I invested in the REIT, the idea was that when I sell it, I'll get capital gains. Now what they are saying is, when it is redeemed, it will be other sources income. It won't be capital gains. So you will pay tax at a higher rate. Capital gains normally pay at 20% long term. This normally pays at 30%, and with surcharge works out to 35, 36, 39. So you will be paying tax at a much higher rate. There's no reason why. Just because you feel that I was getting away with some advantage on REITs is no reason why a capital gain should be converted to other sources income. So that amendment also is perhaps uncalled for. There is an amendment for market-linked debentures, which is again similar to the amendment for the REIT, slightly different, effectively saying the same thing. What they are saying is market-linked debentures, according to them, are effectively giving you interest or a derivative return. And if it is interest, you should pay full tax. You should not pay the lower tax on long-term capital gains. So if a market-linked debenture is redeemed, you will now be deeming that to be a short-term capital gain. You will not be able to take advantage of long-term. That is the idea. That is the amendment. What is a market-linked debenture? A market-linked debenture is a debenture where your interest depends upon what happens, say, to the Nifty. If the Nifty doubles, you will get 5 times your investment. And if the Nifty goes to half, you will get your investment back and no interest at all. So that type of conditions are attached. But that doesn't change the fact that it is an investment and my return should be correctly treated as a capital gain. They have, as I said, treated it as short term. That is the amendment. There is again a drafting issue. The language of this amendment is very similar to the language used in Section 50. Section 50 is for depreciable assets. And there are decisions of the tribunal and the High Court which have taken the view that the deeming fiction uses odd language. The deeming fiction uses the language that the gain shall be deemed to be short-term capital gain. It does not say that the asset shall be deemed to be a short-term capital asset. The net result is the same. You make short-term capital gain by selling a short-term capital asset. You make long-term capital gain by selling a long-term capital asset. But the language of the deeming fiction is the gain will be deemed. The tribunals and courts have therefore done a careful bifurcation and said, the gain is deemed. The asset is not deemed. Sections which give you a benefit for selling a long-term capital asset, you will continue to get the benefit. 54, 54F, other similar sections which are giving you a deduction for long-term capital gains will be available to you because those sections give the exemption for selling a long-term capital asset. They don't give an exemption for long-term capital gain. So one place uses the word asset, another place uses the word gain. Courts have distinguished between the two, given the benefit. If that benefit continues, then this amendment on market-linked debentures will not hurt anybody, will serve no purpose. But then I'm sure they will amend it if they really intend to amend it. And if one can convince them, this is serving a good purpose, then perhaps they will not amend it. Then there is this whole issue of Section 28(4) and benefits or perquisites in cash. This is I think, a misunderstanding somewhere in the minds of the regulators that people are getting away with something they should not be getting away with and they should pay tax. They amended it last year. I mean, to some extent justified, people were getting away. What is that which you get away? So many companies tell their distributors that if you sell goods worth more than 2 crores, we will give you a free holiday trip to Mauritius. Now the distributor or the proprietor of the distributor therefore takes that free holiday trip to Mauritius, enjoys himself. He does not have to spend on it, but he does not offer it as income. He offers his normal commission, his normal profit as income. But he does not offer this holiday trip to Mauritius as income because it is nowhere in the books. That was the position. Is he liable to offer it as a profit? Answer is yes. It's logical. It has come from your business. Because you sold more than 2 crores, that fellow gave you a free holiday trip. That holiday trip is your income as much as your commission is your income. But nobody was offering it. So you amended the section last year and said the company which gives you the free holiday trip will deduct 10% TDS when giving you the holiday. So automatically it will come on record and you will then pay your tax on that holiday trip, and that's the end of it. That part of it went well. The question is, what is a benefit or perquisite on which this 10% TDS will apply? Now, if this is the type of benefit, a holiday trip, a car, a TV set, I can understand taxing it. It should have been taxed by correctly understanding my accounts, but no officer has the time, they can't do that level of investigation, so they tax it through this route. That's understandable. But if it gives me a discount on my purchases, that enters my profit. That is already being taxed. You don't need 28.4 or 194R to tax the discount. That's already taxed. So an argument was put, and it was based on a decision of the Supreme Court, that this section 28.4 and the corresponding section 194R, because both use the same language, would not apply to a benefit in cash. It will only apply to a benefit in kind. It will apply to a holiday, to a car, but not to a discount. The government gave a circular saying, your understanding is wrong. This benefit will equally apply to discounts. We appreciate it will be very difficult to deduct 10% TDS on that. As a special case, as a concession, we are telling you that you need not deduct, but only as a special case and a concession. It is otherwise applicable to all cash also. The issue was open. Now they have amended the section to say, section 28 has been amended, 194R has been amended. Both have been amended to say the benefit can either be in cash or in kind, and partly in cash or partly in kind, and whatever it be, it is taxable and it will be liable to TDS. So even a cash benefit is now liable to TDS. That's the long and short of what they are saying. They will again give a guideline saying discounts will not be liable to TDS. They'll give it as a concession, but they will give it as a concession from the CBDT as a benefit to you, not as a right. Because they also cannot enforce a law which will be almost impossible to enforce. So this is one. Then there is, for startups, a negative provision that even if they get investment from non-residents, then also 5627B will apply. Namely, if you have got too high a premium from them and you can't justify the premium will be taxable. By and large, you should be able to justify the premium. And if you are a registered startup, registered with DPIIT, this provision does not apply. If it is a specified fund, if it's a fund from Gift City, this provision does not apply. It's in the case of others that this provision will apply. So it has a limited applicability. The other is again a similar amendment in relation to intangible assets and other rights. See, various types of rights are charged by various sections of the Income Tax Act. Section 28 on business income will charge a contractual right if you get money out of it, will charge a right to manage a company if you get money out of it, will charge an agency if you get money out of it. Section 28 will also charge a forfeiture if you get money out of it, 45 will charge if you give away your right to do business or your patent rights and so on. So various rights are charged under various sections. I'm only giving a few. Now what they have said is, we are tired of making sections which charge specific rights and specific giveaways. We are making a general section under section 45 and saying, any intangible asset, any right, the cost is deemed to be 0, and you will pay tax on the full sale price. So that's the simple solution. We don't keep on making amendments. We don't keep on amending specific sections to charge you. But I think it is a bit too harsh, but it is there. What does it mean? If you have a right under a trust, beneficial interest, and you sell it, you'll be charged if you get something out of it. I don't know whether that is intended. If you sell your right as a partner of a firm, you will be charged. All these are rights and intangible assets. Till now, this question never arose. Now this question will start arising, and we are going to have a variety of issues. And the last point which I would deal with is the TDS on online games. That's a very difficult one, but I think we should be aware of it, because again, it's going to create a lot of practical difficulties. Today, if you play a game and earn out of that game more than 10,000, any game, in any parlor, if you earn 10,000 or more, you are liable to tax at 30% plus surcharge, etc. And the parlor is liable to deduct tax at source. I have not seen many parlors doing it. Your grandkids go and play, at least my grandkids go and play. Your kids go and play. So many others go and play, minors, majors, all the time. And if you combine the entire gains for the whole year, only the gains, not the losses, then you might cross 10,000. Because the gains by themselves might be more than 10,000. And there are games where you might actually earn 10,000. It's very easy. A card game on Diwali night may be 10,000 for a number of the players on the Diwali night. Now for the other players on that game, each one of them must take your PAN, must then deduct tax, and then pay you the balance of your winnings and pay that tax to the government. And only then that is correct. Otherwise, that Diwali game, whoever has paid you the winnings has violated the law. And you have not offered those winnings for tax, you have also violated the law. So that is the position. So now we are amending that section and making it harsher. What is being provided is card games, lotteries, crossword puzzles, etc. will continue to have this threshold of 10,000. So at least small gifts are not to be counted. Horse racing will continue to have that threshold, so to say. 194B, 194BB. But a new section 194BA is added, which says if it is an online game, if you have used the internet and the computer to play that game, then there is no threshold. Even if you have won 10 rupees on that game, 3 rupees TDS has to be deducted and paid to the government, and 7 rupees must come to you. The only concession given is, if you have an account with that online platform, this TDS will be done at the end of the year, after totaling up for the whole year. So every day you will not have a TDS, you will have a TDS at the end of the year. But it will be there. And if during the year you think you want to use the money to buy a phone, and you go there and withdraw that money, then tax will be deducted on that day. So tax will be deducted whenever you take the money, and if you don't take the money, then on the last day of the year, without any threshold. And as I'm saying, controlling this, finding who has actually played the game, which minor, which major has played, what is his PAN, who is liable to that tax, is going to be a Herculean task. That means every online game has got to now do a very thorough KYC before they allow you to play the game. And then they will deduct tax based on that. And this, of course, luckily applies, as I said, to online, does not apply to offline games. The distinction I'm making is, if you use the internet, this applies. But if you go to a parlor and use the intranet, he is using his own server, he is not using the internet. He is giving you a software through his server, then this section will not apply. Then the old section will apply, the 10,000 threshold will apply. But it's going to make, as I said, things difficult. Well, there are, as I said at the beginning, a number of sections and a number of amendments, and it's very difficult to deal with all of them in this one session. I must thank all of you for having heard me so patiently. Thank you.
Sir has given the whole budget analysis, even in this 2 hours, with so much of clarity, be it direct tax, MSME, or startup, or other provisions of that. So, and only legendary people can do this, and I'm sure you all must be agree with me. Really, thank you so much, sir. I request all of you, please give him a loud of applause. So if anyone has any questions and if they want to ask, sir is there with us. So please raise your hand and you can ask the questions. For the charitable trust.
So charitable trust would take a full lecture by itself, and that was the reason why I didn't touch charitable trusts in this session. It is, and it's also very confusing what they have done. But the key amendments which you must be aware of, the first is a donation by one charitable trust to another. The deduction will now be limited to 85%. So if you donate 1 lakh to another charitable trust, it will be deemed that you have spent 85,000, not 1 lakh. The logic behind that is that if you have earned 1 lakh, the rules allow you to accumulate 15,000, and the condition is you must spend 85%. So they are saying you give donation to a second trust, but you claim deduction of 1 lakh. And keep 15,000 in a sense aside, because you are allowed to do that. So you donate 85, keep 15,000 aside. He gets 85, he donates 13,000, keeps 72,000, donates 72, keeps 13,000 aside. The third trust takes 72, keeps 12,000 or 10,000, and donates the rest. That way, 5, 6 trusts taken together virtually spend nothing. That naturally cannot be allowed. So to stop that game, they are saying even if you donate 1 lakh, it will be counted as 85,000. So that is one major amendment which one must be conscious of. The second is a lot of amendments to deal with registration. You now have a spate of requirements. All existing trusts must re-register. All existing charitable trusts. New charitable trusts must register. That registration can sometimes be 2-step, first provisional, then final. Registration is a process before which the commissioner will examine a lot of things before granting you the registration. But what they are saying is provisional registration we will give you automatically. So if you file, we will give you provisional. It's virtually automatic online. But if later on we find a mistake in what you have filed, we will withdraw your registration. And we will be entitled to cancel, and the cancellation can mean 115 TD will become applicable. If that becomes applicable, you will be liable to pay tax on your entire assets. Whatever you have, the net assets, if you have a liability, you can subtract, but not income, not corpus, you can't subtract that. Your entire asset side at its fair market value, at the maximum marginal rate. There's a question mark whether now maximum marginal rate is 39 or 42.7. Because they are saying the new regime is default, in my opinion, it's 39. But whether 39 or 42.7, it's a large rate. So the charity would be paying tax on its entire assets. This is fine. But let's say you forget to apply for registration. You have to re-register, you don't register. And you have to re-register every 5 years. And the secretary of the charitable trust is not a very intelligent person. And he forgets in the 5th year to apply for re-registration. The trust will lose registration, that's fine. The trust will again be liable to pay tax at 42% on whatever it possesses up to that day. And if it has bought a plot of land at 10 lakhs and it has become 50 lakhs, it will pay tax on 50 lakhs. So in that case, the trust will be out of pocket, and if the trust can't pay, the trustees will pay from their pocket. So think over twice before you become the trustee of a charitable trust. No, because if the secretary of the trust makes a mistake, you might pay from your pocket for his mistake. That is amongst the key amendments to charitable trusts. As I said, there are so many that I would really need a full session to discuss them. Thank you.
Thank you so much, sir. So I request Treasurer WIRC CA Piyush Chandak to propose a very well-deserved vote of thanks.
Thank you, Shweta Madam. A very good evening to the dignitaries on the dais and off the dais. As mentioned by our Honorable FM in her budget speech, this is the first budget of Amrit Kal. And as stated in our mythological stories, there was an event called Samudra Manthan. While relating that event to this beautiful deliberation by our beloved CA Gautam Doshi sir, I was wondering who is going to play the role of Asuras and who is going to play the role of Devas, who will get the share in Amrit and who has to digest poison. But we all are very lucky that our beloved speaker has explained the budget provision, had done this manthan very beautifully, and given us a taste of Amrit by this beautiful knowledge. And I thank from the bottom of my heart, on behalf of the whole team of WIRC, for this beautiful deliberation, sir, and for accepting our invitation, for sparing your valuable time and invaluable knowledge with us. And I also thank CA Praful Chajer, sir, past president of ICAI, CA Durgesh Kabra, sir, CCM, and all the past chairpersons of WIRC, Central Council members, Regional Council members present over here. Also, the office bearers of BCAS, CTC, Malad Chambers of Commerce, GSTPM, AIFTP for joining with us. I also thank to the dignitaries for the publication of our book on valuations today. Last but not the least, success of any program depends on the participants. And I thank all of you for participating in large number with us. And with this, I thank all of you for joining with us. Thank you very much.
Thank you so much. I request Praful sir, all the regional council member, all the sister associations who have helped in today's program, please join us on the dais for the group photo. Past chairman of WRCs, all please join us. Bhavna madam, Sanjeev Lalan sir.
All the office bearers also of all the institute and all the regional council members and all the conveners, co-conveners of study circles, you can also join. Madam, please come. Bhavna madam, please come.